Welcome to Markets Now. I'm Michelle Rook along with John Payne with Hedge Point Global Markets. And we're seeing mixed trade this morning in both grain and livestock futures trade over in the livestock. Cattle setting back with hogs higher, but for how long? We'll talk about that in a moment. And over in the grain trade, row crops higher, wheat lower. And John, really, we're kind of in a weather market here, putting weather premium in, especially this corn market, aren't we?
Yeah, I mean, the most exciting things in my life right now are every 6 hours when these model runs come out. And you've started to see it develop. We can look out pretty much through we'll call it the 5th of June for most of the model runs. And they all agree, the I states are not going to see much rain, if any. And then you go out to the GFS, which is a little bit longer. I think we can get closer to the 10th of June, and it's the same. So, these models will change, obviously, as we move closer to the dates. But at this point, you have to wonder how the yield forecasts will look, what the crop progress numbers are going to look like, as we get into early June, because the moisture levels are going to be so low. So we go into a 3-day weekend tomorrow. We'll get 4 days worth of forecast by Monday. We could look drier or wetter. Obviously, that's always the case. But I think the market's poised to spring here in the shorter run. I think the data and fundamentals tend to be really bearish in the longer, more medium term. So keep that in mind as we rally here on grains. But at this point, whether it be beans, corn, I know they were planted early, but we were early in 12. So I'm not using that correlation as anything towards a record yield. And until these forecasts change, I mean, we pretty much drive through the middle of June. It's going to be hotter than normal. So this is a weather market we tend to see once a year, and it's just a little earlier, I think, than we're normally seeing it.
You bet. So that deals with the new crop side of things, but old crop, you talk about basis levels on corn, man, they continue to widen out, be really strong. That's bullish, isn't it?
Yeah, the basis in the United States is very good. And then really this is kind of a problem globally, is we all kind of step back and look at corn prices, and we usually quote the CBOT. Corn is a different price wherever you go in the world. So if you go to South America, specifically the areas that are harvesting right now, it's sub $4. If you go over to Europe, they're somewhere in the mid to fours to high fours. Then you go to the United States, I mean, we're closer to 6 or 7, depending on the areas you go, just given the old crop supplies that we don't have. We don't have access to the Ukrainian supplies like they do in Europe, essentially right now. We don't have access to those Brazilian supplies like they do in South America. So, you're going to see a couple of different markets develop. You're going to see the board, especially the deferred board contracts. Then you have that front month contract, especially July here, which I think could be very, very volatile as we get closer to the end of May or the end of June. And if the weather doesn't change, because you're going to see folks button up as much as they can ahead of the September delivery. Right now, everybody's pricing off SEP with these huge basis numbers. And I expect that to narrow at some point if things don't change.
Gotcha. What about, the demand side of the equation over on soybeans? And let's talk about products, because soybean oil was driving the bus for 2 years. And now, boy, that thing has really fallen out of favor. But we have seen a big rebound in global veg oil demand, right?
Global veg oil demand has come back higher, but it's not, we're dealing with bigger supplies. So you've got canola / rapeseed oil. Rapeseed oil is what they call it in Europe. Canola is in Canada, obviously. Those markets are seeing supplies increase, and you're seeing prices, dwindle lower. And they're really closer to where they were pre-COVID. When you go to the bean oil sector, we're trading, 47, 48 cents this morning on the CBOT. That was as high as 55 a couple of weeks ago. We were in the 70s when things were really hot a year ago. And those edible oil markets I mentioned earlier never really rallied. So soybean oil still holds this huge premium over the rest of the world. If that goes away, you kind of worry about crush margins here in the U.S. China is a negative story. It's a negative drag right now on global markets. Anything they use, I think you're going to see selling in right now: cotton, hogs, soybeans. So we need the domestic U.S. markets to stay strong, and that's bean oil and bean meal. If the crush margins are strong, I think the crushers will step in and buy. But if they continue to dwindle, that's where you could see the beans really get offered hard. And on a big crop, be sub $10 by the time they deliver. So we'll see. I think it's a long way to go before we get there. We started off at a record yield. I'm venturing to say this is the best yields we've seen now from the USDA. I think they'll fall from here just based off of what we're going to see over the next couple of weeks. Beans were planted early, which some folks will say is a bearish thing, bullish for yield, but it also brings a lot of that heat into question. So where beans are setting pods later in August as things have cooled down a little bit, that's going to happen earlier in August, later in July, where you might get some hot temps, and that's where you could see some abortion of it. But at this point, I think small reductions in the supply numbers in beans should help. Corn's going to need quite a bit of a sell-off here to get the carryovers to come back to where they are right now. But we're much cheaper on those new crop prices, and I think you're going to see the funds cover in those markets, especially given that the farmers have sold there. So we'll see if there's any short covering to be had.
Gotcha. And when I said veg oils, I meant supply had rebounded, not demand, including palm oil. That's been one of the big drivers. What about the wheat market? Some pressure there today. And of course, we do have some pretty good forecasted rains again for some of HRW areas, and they have seen some improved conditions, haven't they?
Well, when it rains, it pours. It's the saying, and that's the case. So folks I work with in the panhandle of Texas, I think have gotten more rain over the last 3 weeks than they have over the last year and a half. I think that's what the guy mentioned to me. So, short term here, I think wheat faces tremendous amount of headwinds, even with the crop, in problematic crop in Kansas. This week, we've seen evidence of demand rationing from the United States. We saw Miller in Houston and in Florida buy big loads of high quality wheat from Europe to bring in and mill in the United States. So we've hit some pretty wide prices on those spreads. You're going to start to see some new markets develop in the U.S. I don't think there's a tremendous amount of downside in the old crop markets, but really when you look at July of 24, and I'm talking to Kansas wheat farmers here, it might be a decent shot to just go out and try to start selling, because we're trading up here at $7.50, $8 on that new crop price. I just think it's going to be difficult to see those new crop markets really rally, much beyond $6, $7 for the new crop, because I think you're going to need to see supply everywhere. So I'd be avoiding the old crop markets. I think the drought you have up in, that we've been dealing with, and the problematic supplies that have come out of Kansas are going to create a lot of volatility in the delivery here. But I think the longer run contracts like December, like July, might be better off sold, because you're going to get new crop supplies coming around, and they could look pretty good given these prices.
Yeah. And it's really sad what you say about the poor demand and the fact that we're importing wheat from Poland and Germany and other places. Cotton market, also, that's a weather play with that improved situation we talked about in HRW areas, right?
Yeah, I mean, if you go to the models and just look, it looks like if you overlaid the West Texas cotton crop with the forecast, I mean, it's exactly where it's going to be. So, and it's early there. I mean, a lot of folks haven't even started planning yet, so it's probably not something to get too worried about. But I think the forecast patterns are something to notice. And if we can get a good dryland crop out there, given the problems we're seeing in China with demand, and really that's where you can kind of focus on demand side with China. You'll wonder if we can continue to trade in the 80s. With a big crop. And that's another one. I think you look at bull spreading. I think July, there's a lot of demand for cotton near term just to get it to meet the market, but that new crop contract might be a little bit of a problem.
Let's stay on the weather theme here, because those improved conditions in HRW areas, cotton areas, also impacting that feeder cattle market, right?
Yeah, all-time highs almost. I'm not sure exactly the number we're all going to use, but just I use the August contract and a monthly continue, and I'm somewhere around 240. I think somebody told me 245 might be the official number, but at this point, you have the conditions there to create heifer retention. You have pasture lands that are going to be available for the first time in maybe a couple of years for folks. You have grain prices that are coming down. They're still expensive relative to where we are in the old crop, but the new crop price is coming down. And you have feeder board doing well, not to mention beef's above 300. So we need to recoup supplies, and that creates a huge amount of demand. All of these contracts that you watch the new crop April, watch the new crop May. They're starting to come on and trade now, and they're starting at 230 to 240. So those are the markets you want to watch here. If we pop up and make new all-time highs, I don't know how high we run. We've never really seen that before. So I think a lot of it depends on the beef. I've been a little bit sheepish up here on beef, especially given what's going on in the pork. But so far, so good. We've held above 300, and the live looks to be like one that you could maybe go out and buy in those deferreds.
Yeah, that spread relationship is still held together quite well. Live cattle, though, certainly we're dependent on where this cash market goes, and the weighted average was up a little bit last week. What are you expecting this week? Because we're buying for a shortened holiday week, and obviously futures are still at a discount to that.
Yeah, we usually tend to bottom at this time of the year in the beef. I mean, I'm not using seasonals this year, especially in the cattle. I don't think they're a smart thing to push on. But seasonally, we tend to do well here. As once Memorial Day passes for beef, it's you got ASF, not ASF, a BSE reported yesterday. I don't think that really did much, but maybe some concerns there with supplies. I still think crush margins. So when you go out and look at crush margins for feeder cattle crush margins are pathetic in the deferreds. I mean, really, really bad. And even this is using cheaper corn. So you kind of wonder, does live have to rally here to get back to where we were? And I think we do. I think it's so hard to want to buy live cattle in the 170s, and I'm talking next year, but this is where we could go. I think the value there is in the live, not so much on the feeders anymore.
Yeah, that BSE case you talk about, atypical, didn't get in the food supply, shouldn't be an export concern. So let's move past that, I guess. Hog market, we're trying to bounce off these contract low areas, John, but the fact that we're down here, what's the reason that we just cannot get out of these levels?
I think a lot of folks, like myself included, we went record short in the mid to high 80s on the contract. And it was like, well, this is a good shot here. We've, last couple of years have seen 3 digits, maybe even go back to 2018, you see 3-digit hogs in the summer. And so guys like myself go out and take a shot, and now you're really paying for it and trying to see, okay, where is this floor? We've seen the pork pretty much steady out, and we've seen the market price for hogs pretty much steady out. Now we just need to see those premiums get put in place. And for the funds that want to come and buy this market right now, they're going to have to buy, into this Chinese story. And right now the Chinese story just is not very friendly.
And that's why we have profit margins for producers that are negative right now, right?
Yeah. And if anybody's out there on the meat side, the buyers of the meat should look here. They should be looking at buying that crush because, we're not going to stay at $60, $70 a head gross for long. We don't tend to stay that way for long. Something will break here.
All right. Thanks for joining us. John Payne joining us with Hedge Point Global Markets, and that is Markets Now.